We've made a nice comeback this year. We had a very difficult first quarter, as I've reported earlier, with a lot of winter storms, in particularly our New England states. We actually had more winter storms in our first quarter this year than we've had in the history of the company. So we've been fighting back all year, and October was an excellent month. It actually has brought our year-to-date combined ratio to 100.6, which is not too bad considering the level of cat activity that we've had this year. We estimate that we'll probably be about a point or so over our normal cat load. So if you kind of pull that out, it gets us a little bit closer to where we would expect to be at this time of the year. We still have a couple of months to go. Hopefully we'll have quiet weather in the fourth quarter and we can get that combined ratio down to 100 or maybe even a little bit below. We also had an excellent investment return in the month of October. Now that was preceded by a very difficult stock market, of course, this summer, but we made a nice comeback in October. We've now added over $30 million to our surplus this year. Our surplus is up to about $1.044 billion, which is pretty good, and hopefully we'll see favorable climate in the investment markets the last couple months of the year and be able to hit our year-end surplus number. We should probably end up somewhere around $1.05, $1.06 billion in surplus by year-end. Our two-star profit centers really continue to be commercial lines and bonds. Our commercial operation has a combined ratio through October of about 94, with a growth of about 2%. Our bond operation has a combined ratio of 89.5, with slightly positive growth. They also had a good October to bring their premium positive for the year. Our other two profit centers, the assumed reinsurance operation, the good news there is our active accounts are operating at about a 97.5 combined ratio, and we're actually growing. We'll probably exceed our premium plan this year. The issue in the assumed reinsurance operation continues to be one old legacy account that's running off for us. That brings the overall program to a combined ratio that's over 100. But it bodes well for the future with our existing accounts operating so profitably. And then our personal lines operation continues to have a combined ratio over 100, but a lot of very encouraging signs there. Our personal auto operation continues to see good improvement in the combined ratio, and we're seeing a lot of very good growth in many of our states. Our homeowners is the line that really took the brunt of the winter storm activity, and as a result, it will not hit its year-end plan. But the last couple months, each month has been very good, and we've been seeing some very nice improvement. Our regions continue to improve as well. Our regional combined ratio through October is actually just a hair over 100 combined ratio. So great improvement throughout the year. It's led again by Florida. Florida's got a combined ratio down in the low 80s, continues to perform very well for us, and we're seeing a little bit of growth there as well. Our Northeast region has gone under 100 for the year. They're at about a 99.8, so very good improvement there and some nice growth on commercial lines. Our New England region, which bore the brunt really of the difficult winter weather, is fighting back and making a comeback, but it still has a combined ratio over 100. It's about 105 or so through October. And the Southeast region is at about a 102 through October, which is an improvement of 5 points over the same time last year. And our West region, which last year through this time was running at about a 117, has improved down to about a 104. And we expect both of those regions will get under 100 as we go into 2016. Thanks again for the business that you give us and the trust that you place us in taking care of your customers. And most importantly, best wishes for a great holiday season. We'll see you again next year.